The financial world is on edge. Investors, analysts, and everyday people are all feeling the pressure as markets react to the latest news. Goldman Sachs, a titan of Wall Street, has sounded the alarm. This isn't just any warning, it's a significant shift in their economic outlook. They have significantly increased the probability of a US recession in the next 12 months. This change in forecast is based on a variety of economic indicators that suggest a downturn is more likely than previously thought. This warning sends ripples of concern through all markets, including the volatile world of cryptocurrencies. Investors are scrambling to reassess their portfolios, and the uncertainty is palpable. The new estimate, a sobering 35%, represents a stark increase from their previous forecast. This figure is not just a number. It reflects the growing unease among financial experts about the future of the economy. It's a clear signal that the US economy is facing significant headwinds, from rising inflation to supply chain disruptions. The challenges are mounting. For the crypto market, this warning is a critical test. Cryptocurrencies have often been touted as a hedge against traditional market volatility, but this situation could put that theory to the test. It could either expose vulnerabilities or highlight its potential as a safe haven asset. As investors look for stability, the performance of cryptocurrencies in the coming months will be closely watched. Economists are debating the potential impacts of this forecast. Some believe that proactive measures by the government and Federal Reserve could mitigate the risks, while others are more pessimistic. For the average consumer, this warning could mean higher prices and tighter budgets. The cost of living is already on the rise, and a recession would only exacerbate these issues. Small businesses, which are often the backbone of the economy, could face even tougher times ahead. Many are still recovering from the impacts of the pandemic, and a recession could be a devastating blow. As the news spreads, financial media outlets are buzzing with analysis and predictions. Everyone is trying to make sense of what this means for the future. Investors are advised to stay informed and consider their options carefully. Diversification and risk management will be key strategies in navigating these uncertain times. As we move forward, the economic landscape will continue to evolve. The warning from Goldman Sachs is a reminder of the complexities and uncertainties that lie ahead. Goldman Sachs points to a confluence of factors driving this increased recession risk. Chief among them is the escalating trade war and the resulting tariffs. The ongoing dispute, marked by tit-for-tat tariff impositions, is casting a long shadow over global trade and economic growth. Adding to the gloom is the weakening economic growth in the US. Key indicators are flashing warning signs. Consumer confidence has plummeted and businesses are hesitant to invest. This decline in sentiment further exacerbates the economic slowdown. The economic impact of these factors is significant. GDP, inflation, and unemployment are the three pillars that often determine the health of an economy. When these indicators show negative trends, it can lead to widespread economic challenges. For instance, a declining GDP indicates that the economy is shrinking, which can result in lower income levels and reduced consumer spending. This, in turn, can lead to businesses cutting back on production and laying off workers, further exacerbating the problem. Goldman Sachs has downgraded its US GDP growth forecast for 2025 to a mere 1%. This downgrade is a stark reminder of the challenges the economy faces. A lower GDP growth rate means that the economy is not expanding as quickly as it should, which can lead to a host of other issues. For example, with slower economic growth, there is less investment in infrastructure and innovation, which can stifle long-term economic prospects. This slowdown is coupled with rising inflation, projected to reach 3.5% by year-end. Inflation erodes the purchasing power of consumers, making everyday goods and services more expensive. When inflation rises, it can lead to higher interest rates as central banks try to control the money supply. This, in turn, can make borrowing more expensive for both consumers and businesses, further slowing economic growth. The unemployment rate is also expected to rise, reaching 4.5% by the end of the year. Higher unemployment means more people are out of work, which can lead to increased financial stress for families and reduce consumer spending. When people are unemployed, they have less money to spend on goods and services, which can lead to a downward spiral in the economy as businesses see reduced demand and may lay off even more workers. This confluence of slowing growth, rising inflation, and increasing unemployment paints a bleak picture of the US economy, raising the specter of a recession. A recession can have long-lasting effects, including reduced economic output, lower income levels, and increased government debt as policymakers try to stimulate the economy. It is crucial for policymakers to address these issues proactively to mitigate the potential negative impacts on the economy and ensure a more stable and prosperous future. The crypto market, once considered an isolated ecosystem, is no longer immune to the broader macroeconomic forces. Bitcoin, the flag bearer of cryptocurrencies, has shown increasing sensitivity to global economic conditions. Factors like liquidity in traditional markets, overall risk sentiment, and real yields now influence Bitcoin's price trajectory. This interconnectedness exposes Bitcoin to the potential fallout of a recession, including risk-off sentiment and reduced liquidity. The potential impact of a recession on Bitcoin has divided experts. Some, like Robbie Mitchnick from BlackRock, see it as a potential catalyst for Bitcoin's rise. They argue that increased fiscal spending, debt accumulation, and potential monetary stimulus in response to a recession could benefit Bitcoin. Others, however, remain cautious. They point to the short-term constraints a recession could impose on Bitcoin, including a negative wealth effect, and its correlation with equity markets, which typically suffer during downturns. Crypto's response to the Goldman Sachs warning has been measured but noticeable. Bitcoin and other major cryptocurrencies have edged lower, reflecting the broader risk-off sentiment pervading global markets. However, the decline has been relatively muted compared to the sharp drops experienced during previous market shocks. This suggests that the market might be pricing in the recession risk, but remains uncertain about its potential impact on cryptocurrencies. Navigating these uncertain times, crypto investors face a challenging landscape. The looming threat of a recession adds another layer of complexity to an already volatile market. It is crucial to approach investments with caution and a long-term perspective. Diversification, both within and outside the crypto market, remains paramount. Thorough research and understanding the fundamental value proposition of each cryptocurrency are essential. The potential recession presents a defining moment for the crypto market. Will it crumble under the pressure of a global economic slowdown, or will it prove its resilience and emerge stronger? This period of uncertainty will test the underlying strength of cryptocurrencies and their ability to decouple from traditional markets. It will also reveal whether investors view them as a safe haven asset or a speculative investment. The warning by Goldman Sachs serves as a stark reminder of the interconnectedness of global markets. In today's world, financial systems are more intertwined than ever before. A ripple in one market can quickly become a wave in another, affecting economies and investors across the globe. This interconnectedness means that no market, including the burgeoning crypto market, operates in isolation, and the economic uncertainties that lie ahead. The crypto market is not immune to these forces. As traditional markets face volatility, cryptocurrencies often experience similar turbulence. This is due to the growing integration of digital assets into the broader financial ecosystem. Investors must be aware of these dynamics and prepare for potential market shifts. Its fate remains intertwined with the broader economic landscape. The performance of cryptocurrencies can be influenced by global economic policies, regulatory changes, and macroeconomic trends. For instance, changes in interest rates or inflation can have a significant impact on digital currencies. Understanding these connections is crucial for anyone involved in the crypto space. As the situation unfolds, investors need to stay informed, manage risk carefully, and adapt to new information. This means continuously monitoring market conditions, staying updated on regulatory developments, and being prepared to adjust strategies as needed. Risk management is not just about avoiding losses, but also about positioning oneself to take advantage of opportunities that arise during market fluctuations, and perhaps most importantly, maintain a long-term perspective. While short-term market movements can be unsettling, it's essential to focus on the bigger picture. Long-term investors often fare better by staying the course and not reacting impulsively to market noise. This approach can help in navigating through periods of uncertainty and volatility. The true potential of cryptocurrencies will likely be revealed not in the short-term market fluctuations, but in their ability to drive innovation and efficiency in the financial system. Blockchain technology, which underpins cryptocurrencies, has the potential to revolutionize various industries by providing secure, transparent, and efficient ways to conduct transactions, but in its ability to weather the storms and emerge stronger. Just as resilient buildings withstand storms, robust cryptocurrencies and blockchain projects will endure market volatility and regulatory challenges. Their resilience will be a testament to their underlying value and potential, and emerge as a resilient and transformative force in the global financial system. As we look to the future, the integration of cryptocurrencies and blockchain technology into the global financial system could lead to more inclusive, efficient, and transparent markets. This transformation holds promise for a new era of financial innovation and growth.